Hi, everyone. My name's Jeff Greenspan, and I'm Managing Director of Financial Modeling Service. Today, we're going to talk about picking the best loan or refi. For most people, your home loan is the biggest loan you'll ever take, so it makes sense to structure your loan in a way that saves you money if possible. To get the most out of this discussion, you'll need to have some basic financial knowledge, so please review my Finance 101 document or video before continuing. Too many finance gurus, who should, in my opinion, know better, fail to use net present value to identify the best home loan for you. They do this for two reasons. One, it's a bit complicated to explain, and two, less complicated techniques often get the right answer. However, when you're talking about amounts exceeding $100,000, optimal is better than okay. So let's get started. Think about a mortgage as a series of cash flows. Each month, you pay principal plus interest and maybe escrow amounts and private mortgage insurance. At some point, you pay off the mortgage in full, or perhaps you sell your house and pay off the mortgage in full. In addition to the typical information we use to calculate the cost of a loan, we need to know two other pieces of information to figure out the NPV of a loan to you: your discount rate, which we talk about in the finance video, and how long you expect to continue owning the home. For our example, we'll assume that Harriet homeowner is buying a $300,000 house, putting 20% down, and she plans to live there for the rest of her life, 30 plus years. She's been told by Barry Banker that she can get a $240,000 30-year loan at 4.5% interest, or a 15-year loan at 3.75%, and that the closing costs are $6,000 regardless of which loan she picks. Harriet's personal discount rate is 7, but that'll come into the next screen. To determine which loan is better for Harriet, we start by taking a look at the cash flows. The outgoing cash flows are as follows. At time 0, we have to spend $6,000. Those are the closing costs. Month 1, month 2 through month 360 on the 30-year loan will cost Harriet $1,216.04, whereas the 15-year loan costs $1,745.33 a month, but only for 15 months. The total dollars spent is down at the bottom of this table. The 30-year loan costs Harriet $443,774 of outgoing cash, whereas the 15-year loan only costs her $320,000. At first glance, it looks like the 15-year loan will save Harriet more than $123,000. Unfortunately, that calculation is incorrect because it doesn't take into account the time value of money. We have to discount the series of cash flows at Harriet's personal discount rate. Let's say her rate is 7%, which is pretty common for many homeowners who are in reasonable financial condition. To determine which loan is better for Harriet, we have to calculate the net present value of each loan. Here, the 30-year loan has a net present value of negative $189,000, and the 15-year loan, negative $200,000. Let's review. First, these numbers are negative because the cash flows out. We don't need to worry about the incoming cash flow. It doesn't affect our calculations at all. Second, it's critically important to understand that a $240,000 loan costs less than $240,000 in each case here, primarily because of the time value of money. That is, the value of the equal monthly payment in the 180th month or the 360th month is considerably less than the value of the same payment in month 1 because of inflation. And 2, the interest rate is less than Harriet's discount rate. If Harriet had a discount rate of 3%, the shorter loan would be a better value by almost $36,000, and the true cost, net present value of the loan, would be greater than $240,000. The story doesn't end here. Harriet was smart enough to ask Barry Banker if she could buy down the interest rate. With this option, which is available for almost every loan, Harriet pays an extra fee upfront in order to get a lower interest rate over time. Barry tells Harriet that she can decrease her 30-year rate from 4.5 to 4% by paying 1.5 points, where a point is equal to 1% of the loan. Or she could pay 2.5 points and get a rate of 3.75%. Harriet is now looking at 4 possible loans: the basic 30-year loan, the basic 15-year loan, and 2 options on the 30-year loan. We could include more options here, but it doesn't really make the analysis any clearer. So, which loan should Harriet select? I've gone ahead and listed the loan net present value for all of these loans. And Harriet should select the one with the highest net present value. In this case, the loan with the highest net present value is labeled buy down 2. Remember, we're dealing with negative numbers here, and a negative number that is less is actually worth more. Think of these net present value numbers as this is the amount I have to spend in order to get a $240,000 loan, and you want to spend the least amount possible. Let's make this a little more complicated. What if Harriet doesn't believe she will be in the property for 360 months? What if she thinks she's going to be in the property for 7 years or 84 months? Well, we can still calculate the net present value of the series of cash flows associated with those scenarios. I've put them here in this table. It turns out that the basic 15-year loan has the highest net present value for the first 8 years. That's 96 months, after which buy down 2 becomes the best value. Harriet Homeowner now has the information that she needs in order to make an optimal decision. The process for determining whether to refinance an existing loan is basically the same. If you know your time frame and discount rate, you can compare the net present value of your existing mortgage to a set of alternatives, and you should always pick the option with the highest net present value. Our company, Financial Modeling Service, will do the analysis for you for a flat $50 fee, and we guarantee that you will save at least that much in net present value when selecting the loan, or the analysis is free. Remember that your situation is unique, and you should not assume that the results shown in this particular document will directly apply to you. Finally, feel free to get in touch with us. We'd love to hear from you, and we're looking forward to helping. Thank you.